Hello, ladies and gentlemen, and welcome to today's edition of our weekly podcast with myself, Russell, and
me, Chris.
Hi, Chris. How have you been this week?
Yeah, busy. Got a lot going on. Doing some work at home at the minute, so yeah, a little bit stretched at this time of year. Only got another week and a half probably of interesting markets. So
interesting, yeah.
Time to get ready to wind down soon.
I'm still waiting for the rally on the ES because it's just been consolidating for days now.
Well, there's some potential triggers you would have thought this week as we look forward.
Yeah, for the Fed coming up.
Yeah, how about you? What was your weekend?
My weekend was cool. I spent a lot of it studying and doing some video editing and stuff like that. So pretty chilled, easy one for me.
All right.
Apart from DJing on Friday, but
I'm looking forward to the Christmas party.
Next week, is it?
Next Friday.
Next Friday, yeah. I will be there, and we're playing some darts. Hopefully, someone doesn't end up with a dart in their head.
Yeah, well, the dartboard's not up in the office anymore, so there's no practice to be done before then.
It's
so
a level playing field then.
More than normal. More than normal.
Okay, so where should we start today? We should probably start with the up and coming Fed decision on Wednesday, right?
FOMC, the last one of the year. Expecting a rate cut. Been a little bit of uncertainty around this. We should probably run into this in the way that Powell has been doing. I know you mentioned this on a podcast a couple of weeks ago. What was his quote? If you're driving in the fog,
you should put your brakes on or stop altogether.
Yeah, slow down, I think was the quote I heard from him. It's one of those where we've been running into this Fed rate decision without any meaningful data, or certainly live data. And in fact, the reactions around the late data that we've been getting have been pretty meek on the whole. By January, things should be back to normal. We'll get everything through on time. But for now, we're still getting the non-farm payrolls next week instead of in the first week. It's all a little bit muddled, and they're not getting that data before this rate decision, which is interesting.
No, because NFP's this week.
Next week.
Supposedly. Oh, so I
think it's next week. I think it was the 16th, I think. Unusual time anyway. Certainly not before their decision, which makes it tricky for them. I mean, we think about what their mandate is. Their mandate is price stability and full employment. Well, they're failing on two counts there. Inflation's up from kind of April this year from 2.2 up to 3% or so. And then we're seeing similar stories on the unemployment rate, up from 4% back in was it April up to 4.4.
It's a considerable raise, right?
So they're kind of losing on both stalls. Both things are moving away from each other, and they've got one tool to try and fix it. And if they obviously cut rates to try and stimulate jobs, then that's going to likely exacerbate the inflation story. And if, by contrast, they care more about inflation at these levels and want to put a cap on that, well, they're going to put more pressure on the job market. So, rock in a hard place.
What's the sentiment at the moment is for cutting rates, isn't it?
Well, this is what he said last time out, last meeting. He was suggested that most members are more concerned about the job market.
Yeah.
Even though they should be concerned about both, arguably. So that leads to the fact that the data, or at least the forecasts, are that we're going to get a rate cut. The view is that rate cut is coming, third 0.25 in a row, to get us down to 3.75. We can maybe toggle over to the chart here. I'm not sure if we're sharing this yet.
And is this a dot plot one as well?
Oh, yeah.
Because I heard something about there's some interesting theories behind the dot plot in that it's going to be completely different to how it was last time. A lot of people are going to be moving their dots.
Yeah, the problem with this is it's the last dot plot of the year, so the dots for year end are just going to be what they voted this time. Yeah. So you're really going to see the focus is going to be on the change from the end of 2026. So it's quite a long way out. So these dot plots, as you get towards the end of the year and then the start of the year, the dot plots at the end of the year isn't maybe as interesting as when you're right in the kind of sights of it as you would have been in the previous two meetings. They tend to be the most interesting ones from that perspective. So you'll see a weird dot plot where wherever they land on their votes, you'll see the votes in a way. It'll almost be like the NPC where you see what everyone did rather than finding out after the event or hearing what Powell had to say. But the view is that with only an 85% chance that we're getting that rate cut, normally by now it's more priced in than this. Okay. So there still is a window there for this potential pause. Feels unlikely given a few things. I know we're going to talk about consumer sentiment later on as well. I mean, there is recession fears knocking around a little bit. Markets, we always talk about this with how stocks react to data. So sometimes currencies are pretty simple, right? If there's high inflation or there's recession fears, good news is good for the currency, right? Black and white.
Yeah.
you know, whether it follows through in the immediate aftermath is another question. But certainly in those moments around the news, that's what happens. Stock markets tend to change and flip-flop from good news is good news to good news is bad news.
Okay.
Right? Or more reasonably now, bad news is bad news or bad news is good news. And last week the ADP numbers were pretty nasty, sent the market down a little bit, although a lot of that was to do with the Microsoft news that came out shortly afterwards as well. But certainly the stock markets were down on bad news. We had a -32 print on the ADP figures. People are focusing more on that now because of the fact that we aren't getting non-farm payrolls. So that might be the only look that we get at the data until we get this one next week in terms of jobs. But stocks are reacting poorly. So I feel like they are kind of definitely more focused themselves on recessions. When bad news is bad news, it tends to be a recession story.
Yeah.
If inflation's the fear, bad news is actually good news because it's going to bring the inflation down. So the markets are more focused on recessions than inflation from that perspective. And if the Fed are the same, which it looks like they are, then I think that rate cut will come.
Yeah, we were discussing this before the right before the stream. It's interesting that we're talking about recessions, but you know all the stocks seem to be doing well. But oil, sadly, is on the flip side of that, right?
Yeah, oil's a good recession indicator. That's certainly pointing down. But stock markets aren't, so there's a bit of a dichotomy there. What was interesting with, I saw a stat from Subu Trades on Twitter. They do really good data. And they were suggesting or did some research on when rate cuts occurred with the S&P within 1% of its all-time high.
Yeah.
So obviously it's rare to cut rates when the stock markets are doing so well. But as we all know, the stock market isn't actually a barometer of the economy. It's a barometer of tech more than anything else. So this AI bubble is what's exacerbating that. But nevertheless, when we've seen rate cuts with the S&P close to 1% highs or within 1% of the highs, and whether we are actually at 1% within 1% of the highs come Wednesday is another question. But if we are, within a year, the stock market has been up on every single occasion.
Okay.
So does that mean a recession is incoming? Or if it is it going to be further down the line and our stock's still going to be higher than they are, you know, a year from now? Certainly the data would suggest so if we get that rate.
Well, I mean, you know, the stocks rallying still could just be indicative to this AI bubble that we're in, just helping that growth. You know, so you know the problem is if this AI bubble doesn't start to reap rewards, how quickly are they all gonna? Are we set for a crash?
Yeah, timing.
Yeah.
The hardest thing to do in trading is to know the day when the high posts and why it's posting. Right.
Yeah.
It's always done retrospectively. It's in everyone's sights, and they do say though that. In trading, it's not or in life, it's not the punch that you see coming that knocks you out, right?
Yeah.
It's always something that's a surprise that you haven't factored for. Where I think the market is very aware that we're in an AI bubble. They're very aware that this is a bit of a circle jerk in terms of who's paying who and who's funding the next, and it is all just, you know, bolstering the balance sheets, which is helping the earnings. So are the earnings really as good as the earnings suggest? This is why Michael Burry was looking to get short of Palantir and Nvidia.
Yeah,
I thought it was all a little bit mystical, these numbers that they were putting together. But we were aware of this. This is like front page media stuff. This isn't something that's going to sneak up from behind and and surprise you. So I think it just pumps. It's still a bubble. Bubbles pump way further than you expect them to normally. I don't think we've maybe stretched as much as we need to. And there's really big numbers above that. I think the S&P will trade. SPX looks like there's huge exposures at the 7,000 level. So what's that? When's option expiry? It's going to be late this year, actually, thinking about it. Yeah, it's going to be the end of the third week. So that's going to be our Christmas party day, the 19th.
Is that a triple?
Yeah, this is a big one. It is. It's a big one. So it's one of the quarterly ones: March, June, September, and of course December. So that's going to be a big one to look forward to on the 19th. So I think between now and then we will have traded 7,000. Whether we trade it in a straight line from the Fed on Wednesday, or whether we look out below first. There are some big numbers. We had some put walls on Tuesday, Thursday, and Friday last week, all at 6,800. So they're my two most interesting prices. And right now we're kind of smack bang in the middle. There's not too much to lean on. I mean, we're a lot close. I think we're due to open at 68.80 at the moment. For today, 0 DTEs, 68.50 looks like being good support, even 60s. Doesn't look like being the biggest day, but then you wouldn't expect it to be. I think the whole market's focused on Wednesday night. If you want to cut this week in half and choose to either trade before the Fed or trade after it, I mean, it's quite clear. Trading Wednesday evening onwards is going to be the time where you're most likely to get some big moves.
Do you ever actually trade the Fed, or do you just let things die down and then?
Oh yeah, we'll be here.
Okay, so you'll actually be here on the night.
Yeah, we'll be in the office on the night. We'll do a live Zoom for clients on that. I'm not sure if we share that to the general public, but we'll be doing live calls.
Yeah, that's something we need to talk about as well. So
maybe a little Christmas present.
Getting you on YouTube moving forward, but we probably should discuss that off the stream, right?
Yeah, let's not do on air admin, as they say. But yeah, so Wednesday night will be live Zooming and live trading through from 7 through till towards the end of Powell's press conference. So maybe worth talking around these Fed meetings, especially with the dot plot, because it wasn't the dot plot last time. That means we get a lot more information at 7 o'clock than we do when there is no dot plot. The dots aren't going to tell us much, but the summary of economic projections, where they believe inflation will be, where they believe growth will be, unemployment, etc. This will be delivered to us bang on 7 o'clock. So we get tons of news at 7 compared to the ones where we don't get the dot plots. That means the moves at 7 on these ones are much greater. They have much more follow through than the moves on the alternatives. So 7 o'clock is going to be an interesting time to trade. You can even just trade momentum if you like, but it might be worth having a look at how these projections are looking. Again, the dots aren't going to tell you a great deal unless you look out to 2026. But if they are fearing recessions in the Fed, then maybe those dots in 2026 will be significantly lower. So that will be one to look out for.
Okay, great. Definitely looking forward to Wednesday. It should be lively.
Yeah, and then the press conference at 7:30 is always interesting. Slightly less interesting when we have the dots, but always worth tuning in for. We mention this, I'm sure, every time, but the trades, the Powell on the mic trades. When he turns up to the room at 7:30, he does his opening remarks for 5 to 8 minutes or so, and then often that's as much information as you're going to get from him, or as much information as he was willing to give directly on the opening remarks. Then we can have a view on where the market might go. He may say something untoward throughout. He might harness something or imply something that shakes the market. He isn't renowned for doing that. He's quite a silver-tongued guy. He's quite good at straight batting a lot of the questions. But when the mic drops, when he finishes his press conference, normally around 8:15, you can then also get a nice reaction, because at that point we have heard from everything he was going to say, all the data and all his reactions to the media, and then the big money comes in with clarity. So even from 8:15 onwards, you can get some really interesting moves. We'll be keeping an eye on where those levels will be, but normally the ranges are quite significant.
So moving on, sort of more recession talk. I know it's all a bit doom and gloom now.
It's Christmas time. Do we need to talk about this?
Yeah, but so I've been sort of hearing quite a lot now about this lipstick index. So you've obviously heard about it.
Sure.
So that's when recessions are sort of going on, that people. It used to be makeup, but it's changed now to different kind of products. But it's the same sort of thing. Is that people don't have large purchases anymore. They do smaller purchases. So so you would sort of ease your sort of I don't know,
consumeristic tendencies.
Yeah,
just
with smaller purchases. So I thought it might be quite interesting to actually look. I did have a look at the index for consumerism, and let's just see how it's looking on the charts.
Should we drag onto the University of Michigan? If I can find the mouse.
I think you just have to click it once and then it comes on. There you go.
Here we are. Okay.
So
let's go over this way, so I can't quite see the corners over here.
Consumer Price Index.
USCI, was it?
Yeah, that's the one. Yeah.
Double click on this. Stick to the University of Michigan.
You can put it on a month. It's put it on the yearly chart. It's a lot.
I think monthly will be also interesting if we reset, because I think we get all the prints. So this isn't quite going back. Here we go. So this is taking us. Well, I started trading in the noughties, right? So this is kind of my timeline, but you can even see we're down at levels we've barely seen since the 80s, right?
So these spikes are all major economic disasters, right?
Well, yep. We've got the 2009. The consumer sentiment was really low post financial crisis. We were at levels. I mean, granted, we're lower than that as we speak now. 2011, we got Greek European debt issues. Here is actually not COVID, it's the inflation push that we had out of COVID. Around these levels, this is weakness in consumerism and sentiment. And sentiment it's known as soft data.
Yes.
This isn't how much people are spending.
No.
This is how confident they are. But it's deemed to be a soft piece of data. The more confident you are, the more confident your spending habits will be. You'll spend more. When your confidence is low, it makes sense that the spending will be lower. In fact, there was the Gallup index that I just saw before we came on air, that was saying that this current spending through, I think it was October, November, was the lowest we've seen on record since 2005. Right, so it only counts for these lows here, but the spending is showing up weak compared to normal, even worse than in 2008 actually, and as is the sentiment. Overlaying the S&P, you might want to have a look at how the stocks reacted around these levels. Now, I've probably change this to be slightly more easy to visualize. So at these lows from 2008 into these lows at 2009, this was into a big sell-off in the stock market.
Yeah.
This was like a 50% decline in the S&P, right? We were in it, right?
Yeah.
Okay, we're not in one. That's one of the differences from there. Similarly, this moved down in 2022. We were in a washout. Now we're in this territory without a washout. We even had a little one in here in 11. I mean, when this is not washout territory, is it?
Definitely not.
No, this is stretching. So it's very unusual to see it here. But normally the reaction in the immediate kind of months after this, you don't have to stretch more than 3-6 months away before the kind of V shape occurs. I mean, we aren't getting the down. That's the only thing that makes this slightly different.
So the main question is, if the sentiment is not to spend, but obviously companies must be, and they are, still earning, right? Where is this money coming from then?
Well, there's a lot of money in the system. That's what caused the problem in 2022, right? We had a huge asset appreciation, and it's still kind of filtering through, arguably, that all the money that was printed in post-COVID, the thing that created all that inflation in 2022. In reality, the S&P 500 is not an index of economic strength. It is an index of how well the tech stocks are doing.
Okay.
So if you probably take out the Mag 7, so you get like the S&P 493, whatever they used to call it. So everybody else, these guys aren't performing as well. I mean, it's not, granted, it's not kind of 50% decline territory either, but it isn't quite as V-shaped as high.
Is there a line on TradingView for just those? Maybe we could have
hopefully someone's made one. S&P 493. No one's done the S&P 493. No, it's not going to find it for us on here. But yeah, these companies are typically less, they have been less of a success story than the tech stocks on the whole.
So the tech stocks really are supporting the S&P at the moment. So
yeah, the Dow might be a more interesting one because, granted, you do have Microsoft taking up quite a large component of the Dow. And in fact, if you look at the Dow Jones, maybe we can, in fact, let's just toggle to the Dow Jones futures now anyway, and I'll overlay the NASDAQ. Because this kind of tells me a story. NASDAQ, obviously, where the tech stocks are more weighted than even the S&P, although the big companies are still the same. If you zoom in on this a little bit, we'll have to go to slightly shorter time frames. Where am I looking here? Yeah, relative to these highs that we had back in mid-November. Now, we have the Dow in the bars here, we have the NASDAQ in the blue. The NASDAQ has gone and superseded these recent highs. The Dow has not. So it's tech that is currently once again outperforming.
Yeah.
Relative to a broader basket of companies that are typically less tech related. So this is still bubble time. It's still blowing. They're still pumping, pushing it up. As I say, these bubbles can push and push and push. Wouldn't read too much into it. I'm more interested in the flow short term. I don't think you need to be too early to the recession washouts when they come. They tend to be quite pervasive when they come through.
Yeah.
So yeah, you don't get rich, or you certainly haven't got rich trying to call the top in stock markets too often.
No.
Maybe Michael Burry's the only man, and even then he had to eat some crap before he made that money back in 2008.
So how is Bitcoin faring at the moment?
Bit better today.
For all our crypto traders out there.
how are the crypto bros? Not been their best time, has it? But it's finding a footing. After what was, again, we've done this before, but the overlay of the NASDAQ versus this, these are very unusually diverging from one another. So it's taken quite a meaningful rally in the stock market, bearing in mind this is a 5% decline.
Yeah.
More than 5% on the NASDAQ. We're not far off the highs. Yet, Bitcoin has done absolutely nothing. It's kind of like bear flagging its way up here. So if we do get a downturn and you want to be short, maybe crypto is a nice place for that extra beta, that extra risk-adjusted percentage declines. You might want to draw a little flag trend line for a break on this. Yeah, you can just see, I mean, you don't have to be a genius to see how underperforming the Bitcoin is compared to US stocks right now.
Yeah, well, I mean, at least it seems to be making its way back up.
This does not look like a buy to me from a purely technical perspective.
No.
Yeah, this is a spluttering rally, dead cat bouncy sort of stuff to me.
Okay, but, well, you know, at least we're seeing at least we're not seeing a further decline, right?
Not yet.
Not yet. Early days yet.
We'll be back next week.
Well, let's not hope. Let's hope not, right?
Yeah.
Okay, so is there anything else that we want to cover today? Maybe we could have a look at oil. That's probably doing exactly the same thing as it's normally doing, because I'm not sure much has changed in the oil.
Pretty weak. We did have a good go on Friday, bless it, but it's really struggled to sustain it. I mean, any rallies have been sold into. We're just getting lower highs at the moment, albeit not taking out this swing low yet. Still not taking out these key levels though. I think it's got to come. This thing's not budging yet, unless there's some meaningful supply cuts, which doesn't appear to be the case from OPEC. I think this goes at some stage. When it does, I think that'll be interesting. But for now, this is maybe if you're a long-term investor, I don't hate buying stocks in oil, given that gold's gone so far so fast. Normally, oil within a year or two starts to do something similar. It's not happening yet, so pretty meek out there for the oil market.
And moving closer to home, regarding the after effects of the UK budget. So I was listening to an article mainly about this mansion tax.
Yep.
So any house over 2 million is going to have to start paying extra. So they reckon that there is going to be start seeing a sell-off in these larger properties, which would bring like the overall price for those large properties down about 5%. So I'm wondering, you know, considering most people, you know, across the world, most of their value is tied up in their property. That's their largest.
Certainly in the UK, yeah.
Yeah, it's their largest asset. I mean, what ramifications could that have for the economy if now we're suddenly starting to see a decline in housing prices?
Yeah, I mean, I wouldn't have thought it would make that much difference to anything that's like sub 1.5. Maybe people start to think about it if they've got a property that's getting close to it, and maybe that caps their potential growth. I mean, this is more of a wealthy problem, and yeah, I think this is something where you might start seeing people knock down a few walls in their house just to get through. Just when the valuations come around, they've not tidied for a while.
Well, you know,
I was running around the front room and they go, you wouldn't pay $2 million for this, would you? And then they clear it all up when they've gone. Who knows? But yeah, I don't know if it's going to be that meaningful in terms of the broader property market for the the 90 percentiles. But certainly at the top end, it's another slight drag.
Yeah. So also regarding the same story is like you said about the valuations. How are these valuations going to be done? Because the argument was that I heard if they have to actually go and physically value all these houses, once you factor in how much it's going to cost to do that, like what money's actually left, how much of the deficit is it actually knocking off?
Here comes the trouble with government, Labour governments and big governments, right? You can generate this stuff, but it costs you money to do it. So was it worth it even doing it in the first place? And all you're actually doing is creating no extra tax revenue net for what is effectively a drag on the economy. So it's a trade-off to be made. I mean, I don't want to get too political on it, but I can see strong arguments against this ever being well enforced.
Yeah. Okay. Well, I mean, yeah. I mean, yeah, same story over and over again, eh?
Yeah, but hopefully it is, and then you can buy that $2 million house down the road on a discount.
I will do. Oh yeah, 5% off. I'll get straight down.
Just what you've been waiting for.
Yeah. Okay, cool. So, anything else to add this week?
UADA's making a visit to London.
Okay.
We're getting UADA in. He's chatting at a more reasonable time tomorrow morning. So we obviously heard potential rate hike chatter from the Bank of Japan last week. That's interesting. We've also got now on the calendars, this has been coming for the past month, this weekly ADP figure. It's now on the calendars. It's taken a while for them to catch up, so I still don't know when it quite comes out. From memory, I think it was about 1:15 when we've been getting them through on the Squawk. This looks at the... Okay, so this isn't actually a weekly one. It's based on this recent week's data extrapolated over a month, if that makes sense. So if it was last week was plus 1,000, then the number will be 4,000. That's kind of how they ramp it out. But this has been poor. We had a minus 13,000 figure, right? Which was
it's really bad. Yeah,
we had. That makes it worse than the monthly figure that we had from last time. So it has been nudging down on the ADPs, and this is all in a time when it's been, in the fog when it comes to data. So I think this will be interesting tomorrow. Whether the Fed care about it, I don't know. And then we're also ramping 2 JOLTS numbers back to back, September's, and then the randomly the late November one. I'm not sure where the October number is. I don't think we're ever going to get it. Maybe they'll. That'll make things slightly different and slightly difficult, I think, trading these news events. Still waiting for next year, I think, before we can lean on them too much. Loads of rate decisions. We've got the Reserve Bank of Australia on the rates. Before the Fed, we've got the Bank of Canada. After that, in the morning, we've got the Swiss National Bank. So there's a big week of rate decisions. I think we're out next week as well. So it's the time of year where they're all quite condensed because everyone's trying to polish things off before they can go out and do their Christmas shopping.
So there's more taking it further afield, and there's more discussions this week about the end of the Russia-Ukraine war. So that's kind of stagnated at the moment. They're kind of at a stalemate. So hopefully some more negotiations can be had on there. And so for all the traders out there, right, when they hear that the war is over,
it's a Christmas song, isn't
it? When they hear that war is over, what are your safe risk on, risk off assets? What's the safe trades to take if you want to follow a end of war momentum trade?
Wow, good question. I mean, stocks typically do pretty well in war. US stocks, there's quite a few big war companies and defense companies who've done very, very well this year, especially in Europe. I would have thought the European stock markets, these guys have struggled. The euro struggled as well a lot when the war began. So I wonder if it kind of opens the door for a bit of euro strength, kind of keeping the wolf from the door a bit. I mean, it's kind of been priced in that it's not creeping into Europe. So a lot of the damage that happened to the euro when this war kicked off in early 2022 was in case there was this contagion, this move through from, I was talking about moving into Moldova and a couple of surrounding countries, which didn't come through. So I don't think it's going to be the big surprise, to be honest. This hasn't been... what's the word? Like, hasn't been, running away from itself for a long, long time. This war, it's been relative stalemate anyway. So to be honest, I'm not that keen on kind of macro post-war trades.
Maybe so we couldn't see a gold sell-off, no?
We could, but I'm still bullish gold. Just fundamentally, I think it's in such a good place. More of a buyer on dips on gold, but I'm bringing this up to show you how weak it has actually been of late relative to the dollar weakness. So in blue we have the dollar index weakening. Really, we haven't really seen too much strength overall in gold right during that time. You'd expect to be seeing the dollar moving to new lows here. You'd expect to see gold at highs, and in reality it hasn't managed to take these highs out. So where we were here on the dollar back in the start of the month, we're lower. Yet on gold we are also lower. So the relative weakness in gold is there. As you say, maybe this is part of the unwind. Give it a week or so, I'm sure we'll be back.
Yeah, I mean, if 3-6 months ago, if we was to see this and we saw Bitcoin performing, we could have used the argument, well, maybe the money's funneling into Bitcoin, but obviously it's not at the moment, is it?
No. There's no money going into Bitcoin yet. Gold is being well bid this year. I mean, the correlations have broken down a bit this year. I mean, there has been times when the dollar was weak that gold did well. Gold has pretty much done well regardless of the dollar this year, right? I mean, the dollar hasn't really had to go down. In fact, it's up from where we were in August, yet gold is up markedly from there.
So this correlation has broken down somewhat with all the Chinese buying that was going on through the Asian sessions. I just don't think it's done yet. So yeah, just in the short term, gold is weak relative to the dollar, so tiny bit of weakness expected. But January, February tend to be seasonally the best time for gold. So see where we are when things dust down after New Year.
Okay, cool. Well, I think that concludes our podcast for the day, and then hopefully everyone can join us once again for the Fed night, whether it be on YouTube or whether they join our free Telegram and get the link from there. So, okay, guys. Well, thank you very much from myself, Russell, and
from me, Chris. Might see you on Wednesday. Look forward to it.
Thank you very much, and have a good day.
Good.